afternoon, everybody. Happy Friday, all you magnificent melon heads. I hope you guys are enjoying your sell-off in the markets this afternoon. Got the Dow's down 300 points, the NASDAQ down 200 and change, giving up all those gains from yesterday. Stocks are not doing so well. I guess it's this sudden resurgence of inflation, driven largely by higher oil and fuel prices, that's driving the sentiment in markets right now. And we've talked a little bit in the last couple of days in some of my morning live streams about this resurgence of inflation, about this surge in energy prices and what it might be causing, and how, CPI could be on the way up. We got a lot of inflationary data points these last few days, but that's not what I'm worried about today, guys. It's not inflation that you need to worry about. And it's hard because after the last few months, the last few years, really, we've all been struggling with inflation. But understand, guys, what is on the horizon right now, what is taking shape, is an immensely deflationary event. And there's almost nobody left alive who lived through the last one being the Great Depression. Anybody who's left alive today that was around for the Great Depression really can only tell you what it was like growing up, not understanding what was happening. All the adults are long gone from the Great Depression. But let me just put it as simply and as plainly as I can. All right, forget your rent. I understand a lot of people are still having rent increases. I understand it's still hard to pay for groceries. I understand the anecdotes are all across the board of life getting more expensive, and that's still happening. We still have inflation. But here's what is also happening, what's taking shape. This is the cloud that's on the horizon, and it's coming, whether you're ready for it or not. The supply of money is shrinking, and the demand for money is rising. Those two things, shrinking supply, rising demand, that's a recipe for higher prices. And what is the price of money? The price of money is interest rates. And have you noticed what interest rates have been doing for the last few months? They have been rising. And have you noticed all the problems that's starting to cause in the economy? There is a liquidity storm on the horizon. Interest rates are rising right now. Interest rates rise slowly at first. And then when the liquidity runs out, interest rates rise suddenly all at once. And that's when all the gears stop turning and things start breaking. And they break so quick you can't even keep track of it. It's happened before. All right? And do not for 1 second think to yourself, they won't let that happen because they have spent years preparing for it. They are making it happen. And stick around to the end of this stream because there's something I want to recommend at the end of this stream. I spent a large part of the day reading this yesterday, and it was a wow moment for me. Shout out to David Rogers Webb. We're going to get to that at the end. But suffice it to say, guys, simply put, money supply shrinking, money demand rising. That's a lethal combination in a debt-fueled economy. And this sudden surge in oil prices, this surge in energy prices, the resurgence of inflationary concerns, that is going to expedite it. Because what are most people doing right now when they fill up their gas tank? As the price of gas goes up, driving CPI higher, are people spending money that they already have on that? No, they're not. They're putting it on the credit card. Credit card debt is rising. Demand for money, debt. And as credit card debt rises, banks are starting to tighten up their lending standards. Supply of money getting tighter. And what happens when the demand goes up and the supply gets tighter? The price goes up. Interest rates on credit cards are rising. This is happening in every corner of the economy. Right? It's happening in businesses as corporate bankruptcies are on the rise. It's happening in the housing market as interest rates and mortgages are skyrocketing and home sales are just frozen in place. Thankfully, home prices haven't crashed yet. It's happening in the commercial real estate market as borrowers are just handing the keys to the buildings back and walking away. And that debt is going up in smoke. And when debt defaults, money is destroyed. Money supply shrinking. And we're seeing it in credit cards as delinquencies are starting to rise and banks are starting to tighten their standards. All across the economy in the U.S., there is a liquidity crisis brewing. And just today, the reverse repo came out. $91 billion in a day, it just dropped to even $1.4 trillion in reverse repo. That's it, guys. That is all the excess liquidity. That is all that's left of all that COVID era stimmies, of all that money printed by the Fed. There's 1.4 trillion left. It is dropping fast. It dropped by over 100 billion just this week alone. And when that money runs out, you better believe something awful this way comes when that happens. And it's dropping really fast. We are going peak doom and gloom today, guys. And there are charts, there is math, there are numbers to back up every ounce of it. This is not FUD. Ignore this story at your peril. And let's shrink my big melon of a head and say hello to my man, Mish. How are we doing today, brother? What's happening, Mish?
Not much. Man, I can't wait it. You know, I love charts.
Mish loves the charts. Calibrate me here, Mish. Am I being too fuddy here? Am I being too doomy with my rhetoric today?
Well, and you're not really speaking in hyperbole, and when people start talking about doom and gloom, they don't have the proof, right? They're just doing these outlandish statements. But if you come in and make the statements and then prove it, to me, it's not really doom and gloom. It's interpreting the way we see stuff.
Yeah, it's math, right? It's charts, it's numbers. I mean, I do the doom every now and then. But I put it right in the screen in front of you. I show you where the doom is coming from. I give you maths and I give you numbers and charts to back it up. Yeah. Well, thank you. So, hey, if you see me, if I get too fuddy, I got a mission for you today, Mish. If I get too fuddy and if the rhetoric gets too overheated, I want you to reel me in. All right. So you're going to keep me honest, kick me under the metaphorical table and say, well, you know, we have this thing that's kind of contrary to that. So you're going to play devil's advocate for today, all right? I don't want to turn this into an echo chamber or a doom loop here, right? So you have an important job today. If you see me going too far with this, I want you to rein me in, all right? That way, we've got one guy playing devil's advocate, and I just dropped that on him. We didn't plan that in advance. I just totally blindsided him with that, and he's like, "What the hell is Jack doing to me now?"
I'm just thinking it's worked so well in the past.
Yeah. Sorry to blindside you with that one, brother. Maybe we'll plan this a little better in the future. All right, let's run through markets real quick before we get into the charts. We've got the fear greed index is still in neutral territory, 52 today. That's down from 55 this morning. The markets are a little bit more fearful today. We've got the S&P is down a full 1.16%. That's 52 points lower, trading at 44.53 with about 40 minutes of trading left in the day. The Dow's down 260. It was down over 300 at one point, giving up most of those gains from yesterday. That's down 0.75%, 34,646 on the Dow. And the NASDAQ leading the way lower, down 217 points, over 1.5% on the tech-heavy NASDAQ, 13,708. And all that's going on despite a slightly weaker dollar today, 105.32 on the Dixie. That's down 8 basis points. Not a lot happening in Forex at the moment. We've got yields continuing to rise. Most of the yield curve is higher today. The 30-year Treasury, 4.41%. That's up 3 basis points. The 10-year is up almost 4 basis points at 4.329. We're going to say 4.33. This is going to be the highest weekly close in the 10-year in a long time, guys. The 2-year at 5.03. That's also up 2 basis points. And the 1 month has broken into 5.40. That's up 1 basis point today. So debt getting a little more expensive. Looking over at commodities, despite the higher rates, gold and silver are up today. Check out gold. December gold futures at $19.38. That's up $6. And December silver futures having a great day, up 34 cents, 1.4% at $23.33. And that's eerily familiar to this morning's number. So I'm going to refresh that window. That's still pretty close. It wasn't exactly right, but it looks like there was a hang up. Correction. December gold futures at $19.45. That's up $13. December silver futures at $23.35, up 36 cents. West Texas Intermediate still going higher, guys. $91 for October WTI oil futures. That's up another 85 cents today. Energy is causing all this discussion of a resurgence in inflation, and that is going to contribute to the story that we're talking about today. And looking at this chart of the 10-year Treasury, look, guys, we got this red line up here. That is the previous high closing of about 4.24 from back in October. We are now firmly above that number. All right. We broke out above it a few weeks ago. We retested and failed, came back up, and then we retested once, twice, and now we're moving higher on those 10-year Treasury interest rates, guys, 4.32%. And I just want to change this to weekly candles real quick. And you can see on weekly candles, definitely a breakout. On the weeklies, I would lower my red line here to, well, TradingView doesn't want to cooperate. If we were to do the weeklies, I'd lower my resistance line to about there. And you can see we are now firmly above. And unless something drastic happens in the next 30 minutes, we are looking at a close above that 4.22, 4.24 line on the weekly candles for the 10-year. So interest rates broke out to a new high from this consolidation pattern going all the way back to last fall. And unless there is some kind of a panic event that happens and everybody decides to run for safety in the 10-year Treasury, this chart is going to keep moving higher. And I don't anticipate that panic is going to start, at least not in the next few days. So I think we're looking at higher rates for the foreseeable future. All right, let's talk about where my sense of doom is coming from. Why am I so worried about a liquidity crisis? All right, first things first, very basics. This is M2SL, or this is the money supply. All right, this is the closest approximation of the money supply in the U.S. All right, there's other indicators and there's nuance to it. There's M1 and there's, all right, but the M2 money supply is the most widely used. This is all the U.S. treasuries, all the savings, all the checking, all the money market accounts, CDs, all combined. All right, and there's about $20.9 trillion of dollars. All right, that is the money supply. Now you can see the great monetary expansion going all the way back to the 1990s. This number really only ever goes up. Guys, go all the way back to the 1960s. This number only ever goes up. Sometimes it goes sideways during bad times, but it only goes up. The last time this number went down, 1930. Not a good time to be around, guys. Not a good time for finances. But I want to zoom in. Let's zoom in at just the last few years. And now you can see, well, yeah, guys, this number actually does go down. This number started going down around, you could say, March of 22 or even July of 22. We kind of put in that double top. But for the better part of the last year and a half, the money supply has been shrinking. That has not happened since the Great Depression. Now, it was shrinking at an alarming pace. And as this was happening, I was warning you guys all in my morning live streams earlier this year. And then something happened around March, April. Oh, that's right. The banks started failing, because that's what happens when the money supply starts contracting in a debt-based economy. Banks start failing, things start breaking. And so what was the Fed's response to the banks failing in March? Well, a lot of people were saying it was the Bank Term Funding Program. Some people said, well, that's not money printing, or, oh, that's not inflationary because this, or because this detail and this nuance. And FinTwit was at war with each other. Everybody was arguing over it. I have a simple resolution to this whole thing. After that happened, the money supply increased. So yeah, what they did was money printing. What they did was inflationary after the banking crisis in March, because the money supply went up. So you can argue all you want about the nuance, the net effect, monetary expansion, that's inflationary. But you'll notice after just a few months, that has now leveled off. The money supply has stopped going up since the banking crisis that hit in the first quarter, beginning of the second quarter. This chart's about to start rolling over and heading lower again, which means I think it's just a matter of time. Maybe as soon as next month, when bank earnings start again, that we start hearing about more problems in the financial system. Shrinking money supplies are terrible for debt-based financial systems, because our system is hopelessly dependent on ever-increasing levels of debt and ever-increasing, ever-growing supplies of money to fuel that debt. Well, we still have the ever-increasing pile of debt. I don't know if you guys noticed, but that's actually getting worse. But what we don't have is the ever-increasing supply of money from which to borrow. And that's the problem. We are literally running out of money to borrow. We've borrowed it all several times. There's nothing left to borrow. And the metaphor I use is dumping garbage in the ocean. In the 1960s and the 1970s, all the trash from New York City and everything. And, I was a child of the 80s. I grew up in the Jersey Shore in the 80s. The ocean was just this big, giant hole that you could dump your problems into, and they would never come back. You just dump it in the ocean. It's the ocean. You can't fill it up. It's huge, right? And then in the 1980s, hypodermic needles started washing up on the shore. Sea turtles with six-pack wrappers around their heads started dying and washing up on the shore. Whales choking on balloons. Turned out the ocean can be filled with our crap. You can dump your problems into this hole, and eventually they come back to haunt you. And that's exactly what we've done with our debt spending in our entire society, personal, state, and local, federal, business, all of us. We've all treated debt. We've treated the future like this hole that we can dump our current problems into, borrowing the money, dumping our problems on the future, and it'll never come back to us. Well, the future has arrived. Whoops. And now the hole is full. We're almost out of money to borrow.
I think I remember back in somewhere in the late 1990s, early 2000s, they said, once we get to the 2020s, things are going to start getting rough financially. But he's like, yeah, whatever, that's 15, 20 years away. It's the 2020s now.
Yeah, and what a decade it's turned into, huh? Oh, 2020s. Guys, we got a lot of 2020s left. It's only 2023, and we still got a quarter of 2023 ahead of us. This decade can get really fun. Just wait.
So sorry I had to come off there, but some guy was at the door trying to pick up a package. I was telling him I don't have a package for you, and he wouldn't take that for an answer.
Huh.
Yeah.
Well, you can stand there all day till you're red in the face. It ain't coming. It's not there. Good luck. Get comfy. All right. So we talked about the M2. Now, why is the M2 shrinking? A couple of reasons. One reason, obviously, has a lot to do with the Federal Reserve. Now, speaking of monetary expansion, these are the culprits of monetary expansion. All right. This is the Federal Reserve's balance sheet. This is all the U.S. Treasuries and all the mortgage-backed securities that the Fed has bought over the years. Let me zoom out a little bit on this. Let's go all the way back to like the 2000s. Okay. Every time things get bad, this number goes up. And then there's a token effort is made to correct the problem. And the effort to correct the problem makes that problem come back even worse. And then the number goes up again. All right. That has happened every time. Here's the GFC. Okay. The Fed prints money, buys up all the crap assets. That wasn't enough. The problem starts to come back in 2011. They do it again. They call it QE2. And they do it again. They call it QE3, QE however many. All right. And then finally, 2018, they started to unwind the Fed's balance sheet. And that ended in a fiasco called repo madness in September of 2019. And they very quietly started printing money again. Now, I want to zoom in on repo madness. And I've said for a while now, I think the most important day in most people's lives, at least most people in this generation, don't even realize that it was September 17th of 2019, because that was right here. That's when we realized, or at least that's when I realized, that there is no getting out from this mess, that we are hopelessly dependent on money printing and central banks buying up toxic debt assets. And that the second it stops, or that the second we try to get out from under this problem, the whole house of cards threatens to fail. That happened on September 17th, 2019. That's when the overnight borrowing rate spiked to 10% from the typical 1 or 2 that it usually traded at. We ran out of money to borrow on that day. And on that day, the Federal Reserve said, well, we better quick print some more money so there's more money to borrow. And unemployment was low. The stock market was high. Everything was really good in the economy. We had the trade war with China was going on, but there were really no big problems. And yet there was this massive problem happening in the debt market. And you could argue that the crisis that eventually led to the woohoo bat flu, as my buddy Chris at Financial Prepper would call it, that really started in September of 2019, because that's when the money printing started. And that just kicked into overdrive, obviously, when they locked down the economy. Now, we went from around $3.7 trillion on the Fed's balance sheet in 2019 to almost $9 trillion. All right, guys, we printed something like $5.5 trillion and bought all the debt with that $5.5 trillion of printed money. That lowered interest rates because we bid up the prices of the debt. Now, about March of last year, we started to unwind that debt. And we have since then unwound about $850 billion. That's not even a fifth of the money that we printed during the pandemic. It's not even a fifth of it. All of the problems, the bank failures, a year and a half of quantitative tightening, the spike in interest rates, the frozen housing market, people can't afford cars because the payments are so high, $1,000 a month car payments, credit card interest rates pushing 30%, all the problems, these high interest rates. And we've only unwound Not even a fifth of all the money that we printed and all the debt that we bought. So we would, just to get back to where we were when everything broke in 2019, we'd have to keep this up for 4, maybe 5 more years. We don't have that much time.
Well,
I'm just trying. Go ahead, Mish.
Yeah, I was going to say that $850 billion is very much similar to how far the reverse repo has come down since May.
That's correct. And we're about to get to that reverse repo because, man, that's one that when you look at the reverse repo chart, I want you to think of a lit fuse because that's exactly what that is. And I also want to add, guys, that, look, you notice this little hiccup here in the chart? That's the bank failures. Again, that's when, everybody was arguing, was it money printing? Wasn't it? Was it a bailout? Wasn't it? Hey, look, the Fed's balance sheet went up. The money supply expanded. Yeah, it was money printing, guys. You can argue the definitions till you're red in the face. And I'd love to. It's a thrilling debate, and I might actually learn something, but the net result was the same. They printed money and they bought debt with it. The money supply expanded. It was inflationary. All right. Now, the Fed has continued their quantitative tightening ever since, so we're back on that prior trajectory now. But you can see we only made it a couple of months before they had to reverse again. We're not going to make it 4 more years. We're not going to make it 5 more years. And that's just to get back to where we were when things broke in 2019. If we go even lower, who knows what else breaks? So the point is, the tools that they're currently using, Jerome Powell's tools that he loves so much, they are not the right tools for this job. You cannot possibly fix this problem with the tools that they think they can fix it with. They only make it worse. Now, Mish just mentioned reverse repo. Let me zoom way out again on reverse repo. Okay, this reverse repo, think of this as extra money in the banking system, and the banks don't really know what to do with it. They don't want to buy any more U.S. Treasuries with it, so they just park it overnight at the Fed, and they get 0.0, or what do they get? Right now, they get about 5% interest doing that. Is it 5? Yeah.
5.25, right?
5.25. Thank you.
Yeah.
So this is the extra money that was printed during the pandemic. You can see it was about a year after the pandemic that this reverse repo became a standing facility, meaning they're going to leave it open all the time. And it started to rise. It kept rising because we kept printing money. They're all through 2021. I cannot imagine why they kept printing that money in 2021 when they told us inflation was transitory and they had the tools and all that fun stuff. And they just kept doing it, even though this pile of extra money kept getting bigger and bigger and bigger. So obviously we didn't need the money that they were printing. I don't know why they kept doing it, but they did. And then, of course, that stopped with the taper. That was at the end of 2021. Now let's zoom in. And then in March of 2022 is when they started quantitative tightening. Now, I just want to point out, guys, that the reverse repo didn't start falling in 2022. All that extra money just kind of sat there. It creeped up, it crept down. We had that big spike at the end of last year to 2.55 trillion. But then it came back down. Really, we stood at about 2.2, 2.3 trillion right up until earlier this year. Earlier this year, right around the time the banks started failing, around March, April timeframe, right around the time of the debt ceiling was a little bit after that. That was May, June. You'll notice the reverse repos finally started to move down in a meaningful way. And it moved down pretty quickly as Janet Yellen sucked all the liquidity out of the bond market. She started issuing a lot of short-term treasury debt. Government deficits started blowing out. Interest expense on the national debt was going through the roof as we borrowed at these higher interest rates. There was a little bit of a pause in July and August, and now it's dropping again very rapidly. But I want to zoom in, guys, even further, because look at what's happened in these last couple of weeks here. Look at just since the end of August. Look at what has happened here way, way down since the end of August. Now, this is something new because we're going to see in a little bit, companies have started increasing their borrowing, not just the government. The government is borrowing at breakneck pace, even though we're out of the pandemic. We're not at war. There's no reason for the government to be running $2.2 trillion deficits, and yet they are. And the reverse repo is falling at an alarming rate. Just today, it was 1.49 trillion yesterday. It's 1.40 trillion now. $90 billion drained out of this thing in a day. down to 1.4 trillion. This thing is empty and fast. This is the only extra money that's left, guys. This is the hole that can't be, that can never be filled. When this gets to zero, the hole is full. There is no longer a future to borrow money from when this runs out. This is the fuse that is lit. And when the fuse runs out, use your imagination. And it's dropping very fast. At this pace, I don't know, 6 months, maybe 9, this thing's going to be empty. And you don't want to be around when that happens. You don't want to see what that looks like, because now all the banks are trying to borrow money from each other, but there is no money to borrow. So what happens? Demand stays the same. Supply is exhausted. The price starts to rise. Interest rates blow out. It's repo madness all over again. September of 2019, all over again. And, let's talk about this, because with repo madness in September of 2019, September 16th, September 17th, that was a very familiar event, because something just like that happened on this very day in 2008. September 15th, 2008 was Lehman Brothers collapse. And Lehman Brothers collapsed because in the middle of the night, none of the banks knew what collateral was worth what, because the mortgage bonds were failing at such an alarming rate. And so mortgage bonds was one of those things that the banks used to trade with each other back and forth in huge quantities in the middle of the night, because, hey, I need money to pay my bills. Here, hold my bonds. I'll borrow your money. I'll pay you back tomorrow when I get paid back. And the money kept moving in massive quantities. And as long as the collateral was viewed as safe, the banks were willing to make those big, massive loans to each other. But on September 15th, 2008, nobody really knew what those mortgage bonds were worth. And so nobody would accept them as collateral for a loan. And so there was no money available to borrow. And Lehman Brothers was the one holding that hot potato when the music stopped and they collapsed. What was it at? $600 billion, $613 billion bankruptcy when Lehman Brothers failed.
Now, they waited until the after hours, right, to announce it?
I don't know when the news dump hit. I don't know if it was a Friday, but I'll be honest with you. I was in my 20s back then. I wasn't following this stuff that closely. So the timing of the day, I don't know. But that was Jim Cramer's "they know nothing" slamming on the table after he was telling everybody to buy Bear Stearns stock when they were heading into bankruptcy. That was messy, guys. When the lending stops, when the banks don't know what's safe and what isn't, when the money stops flowing freely, everything starts losing value instantly. And that happened on this day in 2008, and Lehman Brothers failed. Now, the Fed stepped in, and the Fed said, we'll buy all that crap. They printed money, so now the Fed dumped all the money into the market, and they took all that toxic collateral on their own balance sheet, which means basically they just spread that risk out across all the taxpayers. And that's how they solved that problem. But you know what? They didn't have a big inflation problem back then. They didn't have the damage to their reputation caused by transitory. They didn't have this current set of problems that we have. Well, the problems that failed Lehman Brothers did not go away during the GFC. We just kicked it down the road. And now we're back at that can. And they're going to try to kick it again. Now, while all that's going on, while the supply of money is shrinking, and while the reverse repo, the extra money that's available to borrow, is shrinking, we've also got the federal deficit is exploding. So the demand for money is rising, because that's what debt is. Debt is demand for money. Right? Debt is saying, give me your money, let me use it, and I'll pay you interest for it. And look at what the deficits have done over the last few years. And again, speaking of the hole that can never be filled, governments borrowing money is the same stupidity of dumping your garbage in the ocean and thinking it's never going to come back to haunt you. It's the same thing. And, a lot of the people who were like, oh, we need to save our environment and the oceans and everything, and all the people who said, I told you so there, They tend to be the people right now who are saying, just borrow forever. It can't possibly cause a problem. They don't realize it's the same problem. All right. And hey, you guys on the right, you're kind of guilty too. All right. Because, the right talks a big game when it comes to deficit reduction. And then the right gets in power and they don't do shit about it ever. They usually make it worse, don't they? Maybe they make it worse a little slower, but they do make it worse. That's the one thing the left and the right both have in common is they both make things worse every time. Isn't that nice? Isn't that nice? Libertarians, get your act together. Maybe you win one. Got high hopes for this guy in Argentina. Malay, loving those sideburns. It's like an Argentine Neil Young running for president. Anyways, these deficits just keep getting bigger. Well, what is a deficit? This is government bonds being issued. And when the government issues bonds, they're adding more bond supply to the market at a time when there's already a lot of supply in the bond market. So if you add supply, but demand stays the same, what happens to price? Price goes down. And remember, bond prices and bond interest rates are inversely correlated. So if bond prices are going down because the government is dumping all this bond supply, that's driving the interest rates up. Again, this is sucking liquidity out of the bond market. These massive government deficits are making the liquidity problem worse, and there's no excuse for it. We're not at war. There is no pandemic going on. There is absolutely no excuse for running a $2.2 trillion deficit this year. Inexcusable. Just stupid politics, short-sighted, get my poll numbers up for another month stupidity. I got to pause for a second. I got to say thank you to Justin Carslake. Thank you, Justin. I appreciate the super chat, sir, and the support of the channel. He said, what is happening with buy now, pay later lending? Look, buy now, pay later is just, it's symptomatic of the same problem. Who cares how much the interest costs? Who cares how big it makes the problem tomorrow? I just need my fix right now. Right now, buy now, pay later. There's a lot of negativity around that because it's often very predatory, right? The terms, they're like sharecropper rates. Once you get into like payday lending, that kind of thing, if you're out there taking payday loans, you're never going to dig out from that hole. All right. It's financial servitude. So there's a predatory nature about the buy now, pay later thing and the payday loans. But ultimately, it's the same thing. It's just debt. It's dumping your current set of financial problems onto the future. And the future is just this hole that can never be filled. It still makes things worse. And, the future's catching up to us, guys. It's demand for money is what buy now, pay later is. Right. And right now, there's more demand for money than there was before. There's less money than there was before. The price of the money is going higher. Thank you, Justin. I appreciate that. Now, I noticed you capitalized buy now, pay later lending. Is that a proper noun? Is that a company, buy now, pay later, that I don't know about?
I mean, it is a proper noun now.
It is really. Oh, I didn't even know about that one. I might have to do a closer look at that. But it's just debt. It's more debt is all I take it without knowing the specifics about this particular company.
Expensive debt, though.
It's very what?
Expensive debt.
Yeah. And speaking of expensive debt, guys, that is what everybody is increasingly turning to. Right? We, the consumer, is turning to things like buy now, pay later, expensive debt, payday loans, expensive debt, credit cards, expensive debt. What are the banks doing? The banks are borrowing from Federal Home Loan Banks, the Fed's discount window, the Bank Term Funding Program, brokered deposits. You know what that is? That's expensive debt. They're making the problem worse. They're paying extra to get short-term cash to meet their immediate needs because they're just trying to keep the bubble inflated a little bit longer. We've seen this before. It plays out like this every time. Thank you very much, Justin. I appreciate the super chat, sir, and the support of the channel. Now let's talk a little bit more about these government deficits because this is a big player right now, probably the biggest player. And I want you guys to realize while the Fed has been fighting inflation with the interest rate hikes and with the quantitative tightening, the other part of the government, the executive branch and Congress, through their own stupidity, they have been counteracting what the Fed has been doing. You had last year, the government was spending down the Treasury general account That was spending more money into the economy. You've had these blowout deficits. That's very inflationary, spending more money into the economy. So the government debt spending of these last 2 years has offset everything that the Fed has tried to do. They're like parents fighting in front of their kids. The Fed is raising rates and trying to destroy money while the government lends money into or borrows money into existence and spends it into the economy. So these two things pulling in opposite direction, and we're in the middle, literally being stretched thin by it. So this has been countering some of the deflationary natures. It's one of the reasons why inflation has been so stubbornly high and why it's taken so long to come down. The Inflation Reduction Act did the opposite. Like every government program, whatever they call the act, it usually does the opposite. The Inflation Reduction Act was no different. It was trillions of dollars of debt spending, which is very inflationary, and it's countered a lot of what the Fed has done. Again, it was just short-sighted, get my poll numbers up in the short term. That's all it was. And check out the deficit tracker here. Now, each bar here represents a different year. The red line, that's 2020. All right. We're going to ignore 2020 and 2021. Those were peak pandemic years. They were stupid. Let's not use them as the measuring stick of success. All right. Just saying we're not quite as stupid as we were in 2020 is not a good thing. All right. Congratulations. You're not supposed to be as stupid as we were in 2020. But here's the number right now, 2023. And this is scary, guys, because the pandemic is over and the war is over. We're not at war right now. So why are we currently running a $1.5 trillion deficit in the first 9 months of the year, the first 8 months of the year? We're on pace to spend something like $2.2 trillion of borrowed money this year. We are going to borrow more money than we borrowed in 2019, more than we borrowed in even 2022. And again, borrow from who? Who are we going to borrow this money from? We're running out of money to borrow. The Chinese? The Japanese? Nope. They're not buying our debt anymore. They're selling our debt now. The Federal Reserve? Nope. They're not buying our debt. They're selling our debt. So who is the government borrowing it from? Us, banks, our money. And we're not buying at these rates, and so the interest rates are going higher until they find buyers. Now let's talk about the Chinese and the Japanese real quick, because this is a problem that could make things worse. Talking about liquidity here. China and Japan holdings of U.S. Treasuries. This is going back to 2012. Both of these charts are heading lower, guys. You know, we've heard for years about, if China really wants to screw us, they could just call our debt or they could sell our debt. That's exactly what they've been doing. They've already sold, I don't know most of it, but the Chinese, they previously had about 1.3 trillion back in 2013. They're down to like $850 billion left. They have already been selling our debt. And you know, the Chinese, they're probably going to start selling more of it very soon, because they've got a currency crisis going on. The value of the yuan is tanking right now, and it's only a matter of time before the Chinese sell even more of their U.S. treasuries to get dollars so that they can dump those dollars to buy their own yuan to try to prop up the value of it. Well, what happens to U.S. government bonds when the Chinese sell more, when they add more supply to market? Demand stays the same, more supply, price goes lower, interest rates go higher. So the Chinese selling our debt, it's going to send interest rates even higher. It's going to lead to even more government deficits because the borrowing cost of the government is going to go up. And look at how much the Japanese sold last year. When the Japanese had to step in and defend their currency, look at what happened to the Japanese holdings of U.S. Treasuries, which this is a common misnomer that we owe all this money to China. We actually owe more to Japan than we owe to China. But even that number is in decline. Yeah, they bought a little bit over the last few months. But guys, this has been going down rapidly as the Japanese have been defending the value of the yen because of their yield curve control policy. The yen has been in free fall. Well, the yen is back near the highs of last year when these big sales happened. So we're looking at probably another big leg down like this in Japanese sales of U.S. treasuries. That's going to suck even more liquidity out of the bond market. And guys, these stories are coming. Here's a couple of stories from just the last few days. China asked big banks to stagger and adjust dollar purchases. All right, the Chinese are trying all these little stimmy measures right now. They're trying to avoid the big money printing jobs like we do here in the States. So they're ordering their big banks to not buy dollars as fast. Just wait a little bit before you buy the dollars you need to pay back your bonds. So they're already, this is something that you do right before you start selling your U.S. treasuries. You order your banks to just not buy as many dollars. Alleviate some of the selling pressure on the renminbi or the Chinese yuan. And the Chinese also, they just recently cut the reserve requirements for their banks. They cut the amount of cash that banks are allowed to or required to hold. This just happened, I think this was last week. It was the second reduction in the reserve requirements. Again, the Chinese are already doing these little stimmy measures right now to try to shore up their banking system, to try to spur lending, to try to defend their own currency against the U.S. dollar. It's only a matter of time before the Chinese start dumping even more of their U.S. treasuries. And this is the value of the Chinese yuan versus the U.S. dollar. And you can see here as this chart moves up, that's the yuan getting weaker. As it moves down, that's the yuan getting stronger versus the dollar. Now, here's where the Chinese started defending back in 2022 in November. All right, they started dumping a lot of our debt, and that did work. That did strengthen the renminbi. It strengthened the yuan against the dollar. But now here we are right back up to that level. Any day now, the Chinese are going to start dumping more U.S. treasuries, sending liquidity even lower in the U.S. market, driving interest rates even higher. And the Japanese doing the same thing. It's a very similar chart. Here we were back in October when the Japanese started defending the yen by selling U.S. treasuries. And it worked. The yen strengthened. The U.S. dollar got a little weaker. But now here we are. It's creeping right back up. And we're almost back to the same level we were at back in the fall when the Japanese sold U.S. Treasury debt in order to prop up their failing currency. So two of the biggest historical buyers of U.S. government debt, the Chinese and the Japanese, are both in a position now where they're probably going to start dumping a lot of it very soon. When that happens, what are they going to be doing? They're going to be adding bond supply into the bond market, lowering bond prices, raising interest rates even more. Liquidity is being drained from every possible avenue from the bond market right now. And again, guys, this in a debt-based system that is ever dependent on more debt, on more money, this is catastrophic. And by the way, the BOJ, they see a gap between Ueda's remarks. This is just basically the Japanese saying we're probably not going to back off of our yield curve control policy as soon as some of you guys thought, which also means that the Japanese are probably going to need to defend their currency for longer than some people previously thought, which means the Japanese are probably going to start dumping our debt very soon. This is right about the level where they dumped it last time. Now, let's talk more about the shrinking supply of money and the increasing demand for money.
Oh, I want to talk about Ueda real quick.
Go ahead.
When Ueda came in April, everybody was like, oh, he's the hawk. He's going to go in and change everything. He has changed nothing. There has been nothing but status quo. And he has turned into a nothing. He's supposed to be a huge hawk. He's even worse than a dove in our case.
You know, I was one of those that was saying that, Mish. I did think Ueda was going to come in on day one and be a hawk. And you're right. I'd stop short of saying he was a nothing burger. He has allowed the 10-year yield on the Japanese JGBs to rise, a couple of basis points. But considering how low it is versus the rest of the world, you're right. He's done next to nothing so far. I guess it didn't help that he took over right as U.S. banks started failing. So maybe he figured right now is not a good time to change things while banks are failing in the U.S. and Credit Suisse is failing. But right now there's no banks failing. So Ueda is taking his sweet time. You're right. And again, Ueda taking his sweet time means the Japanese are probably going to have to dump more of their U.S. Treasury holdings to defend their currency for longer. So that adds to our liquidity problem. Now let's talk about this one in S&P Global Market Intelligence, because this is another thing that is adding to liquidity problems in the bond market. This is adding to the shortage of currency, adding to the shortage of dollars. August adds 57 more U.S. corporate bankruptcies. 2023 total tops the prior 2 years. This isn't getting much press this year, but this is a big problem. Corporate bankruptcies are on the rise big time. In the first 6 months of this year, just through the end of June, there was more corporate bankruptcies in the United States than there was in all of last year and all of the prior year before that. Companies are failing. Why? Because debt is getting more expensive because they can't afford to refinance their debt, right? Because the liquidity is vanishing from the bond market. Now, when companies go bankrupt and their debt defaults, money is destroyed. When loans are created or when loans are issued, money is created. And likewise, when loans are paid back or when loans are defaulted on, that money gets destroyed. And right now, the defaults are rising. They're still low. All right. The default rate is not yet at an alarming level, but it is rising at an alarming rate. So at this rate, it will soon be at an alarming level. And U.S. companies are failing faster than they have for years. Just want to read you a little bit of this. U.S. corporate bankruptcies filed year to date have exceeded annual totals for both 2021 and 2022 as companies continue to face high interest rates and a tight labor market. S&P Global Market Intelligence recorded 459 bankruptcy filings in 2023 as of August 31st, more than the full year totals for 21 and 22. The year-to-date figure is also higher than the comparable total for all but 2 of the prior 13 years. 57 companies sought bankruptcy protection in August. While that total was a little lower than July's 64 filings, it was still markedly above most months in the prior 2 calendar years. The number of bankruptcies, does this have a chart? It doesn't have a chart in it. But guys, the number of bankruptcies already this year higher than the entirety of 22 and 21. Now, as this is going on, as bankruptcies are rising, we've also got companies are trying to borrow more. Even good companies that are in no risk of failing, they've all decided suddenly in the last couple of weeks that they all want to borrow money. And this is interesting because money is very expensive right now. Why are all these companies suddenly deciding to borrow at higher interest rates? Maybe they're worried that in a few months, there won't be any money left to borrow. And they know that when that happens, when there's no money left to borrow, the value of everything, and I do mean everything, starts to fall. And when that happens, if you're one of the few people left with any money, you can buy up everything at a cheap discount. Maybe that's why companies are eating these astronomically high interest rates to issue bonds and borrow money now while the getting is good. Rising bond sales suggest companies don't expect debt to get cheaper anytime soon. Borrowing money is more expensive than it has been in a decade, and companies are paying the price. Large companies with top credit ratings issued bonds at a record clip this week. This was a week or two ago, despite a rise in treasury yields that sent borrowing costs to a roughly 15-year high. 19 companies on Tuesday sold 47 bond tranches in the U.S. investment-grade market, according to PitchBook, a record since the data provider began tracking deals in 2012. Guys, understand what that means. Interest rates are right now higher than they've been since 2007, but companies are borrowing at a record pace. Usually higher prices reduces demand, but that's not happening. These higher prices are actually causing demand to rise. Why would companies do that? Why would they borrow when the price is higher unless they think something bad is about to happen, unless they think if they don't borrow now, they won't be able to borrow at all in a few months. Tuesday's bonds. Go ahead, Mish.
I think people are also running to cash to have cash when they need the cash to buy up other people that don't have the cash.
Yeah, I think that's exactly what's going on. I think they're just eating the interest rates, and this is expensive debt. Interest rates have risen, but they would rather eat the interest rate and have the cash when the liquidity event happens versus not have the cash when the liquidity event happens. Because, you know, guys, when there's no more money left to borrow, when everybody is in line to borrow at the same time and interest rates are going vertical, who's ever got cash in that environment is king. I mean, cash truly is king in that environment. Now, it's hard to imagine this after living through the inflation of the last few years where it seemed like your money was becoming worthless at an alarming rate. But then the Fed went and raised interest rates at the fastest clip since Paul Volcker. And in a debt-based economy with a mountain of debt like we have, you have no idea how many problems that's going to cause. They did it so fast that we haven't even felt the effects yet. I use the analogy of when you stub your toe. You know, you're walking around in bare feet and you kick the leg of the table and you're just bracing. You know you've done it and you don't feel it yet. Oh, crap, here it comes. And you know how much this is about to hurt. That is what the Fed has just done with the rate hikes. The economy hasn't felt it yet, but the damage is already done. The signal just hasn't reached your brain. It's coming, right? And that's because when they raise rates, everybody doesn't instantly borrow at those new higher rates, right? Your company borrowed money in 2015 or 2016 at low rates. The Fed raised interest rates last year. You're still paying your 2015 interest rate. You're still paying your 2016 interest rate. It's when that debt matures and you need to refinance. Oh, crap. Now I'm paying the interest rates based on what Jerome Powell did. All right. So there's that lag effect. It takes time. And that time is coming. It's now been over a year since the rate hike started. It's been about a year and a half. And you see it with those bankruptcies on the rise. It's starting to hit companies. All right. Let's move on a little bit. Let's talk a little bit about credit cards, all right? Because it's not just companies that are borrowing. It's not just companies that are defaulting. You got individuals too. And this is one reason why I think this story about the gas, about the surge in inflation and oil prices going higher, I think that's going to expedite this liquidity event. Believe it or not, the return of inflation could expedite the deflation. Because what are people going to do when they go to the gas pump? How are they going to pay? They're not going to reach into their pockets and pull out cash. Nobody has cash. Everybody spent their savings. Everybody's going to put it on the credit card. There's going to be more demand for debt that is getting more expensive. This is America's credit card bill going all the way back to 2002. And guys, if you've been watching this channel for a while, you've seen this chart. I've been warning about this chart like a broken record for months. Americans are putting the cost of inflation on the credit card, and this is going to end in tears for so many people. This doesn't go away, guys. Over $1 trillion in credit card debt, and it's still rising. This shows no sign of slowing at all. Nobody has made the adjustments. And look, guys, I sent somebody an email recently. I get a lot of messages from people who say, no matter what I do, I can't make ends meet, and I'm really trying. And honestly, I don't know what to tell somebody in that situation because I don't know, are they caring for a sick relative or something? And I try not to belittle people's hardships or anything. But when we're dealing with the cost of inflation, you guys need to forget words like fair, and you need to forget words like deserve, okay? Because the fact is, it's not fair. You didn't increase the money supply by $6 trillion during the pandemic. You didn't create the inflation. It's not your fault. You don't deserve a reduction in your standard of living because it's not your fault. That does not change the reality that your standard of living is no longer affordable. The lifestyle you had in 2019, if you were living paycheck to paycheck, you can no longer afford that in 2023. Not even close. All right. So forget fair. Forget deserve. It's irrelevant. It is not fair. You don't deserve it, but it's real. It's a fact. You can no longer afford it. And if you're putting your old standard of living on the credit card, then you are condemning yourself to an even lower standard of living when the bank cuts you off. And the bank will cut you off soon. We're starting to see that. So it's hard, and I'm not trying to belittle the suffering of people who are going into debt trying to maintain their standard of living. And guys, I've been there. All right, I know what it feels like to go to bed and not know what you're going to eat the next day. I've been there before. It sucks. But the reality is you can't afford 2019 lifestyle anymore. You just can't, unless you're one of the few who just got the 40% raise. I mean, that's what the UAW is trying to do right now. The UAW is trying to reclaim their prior standard of living.
Well, I think people are focusing on the wrong number with that. Everybody's focusing on the 40%. they're trying to go from $28 to $40 basically because they haven't had a raise in so many years.
Yeah, and also it's not an instant 40% raise. It's a 40% raise over the next 5 years. And, look, you've seen something like a 20 to a 30% reduction in your standard of living over the last 3 years. So you need a 25, 30% raise just to break even to where you were a few years ago. And now we're talking about over the next 5 years, which who knows what they're going to screw up next. So, yeah, they're asking for future raises too. I know the numbers seem high, but when you look at it in the context of what has been done to the average person, it's not. It really isn't. Now, let's talk a little bit more about these credit card debts, because this is credit card delinquencies for all commercial banks. All right, and I talked about this on my Patreon Zoom call on Wednesday. Shout out to my Patreon supporters. Thank you guys for everything you do in the channel. Link down below should you feel so inclined. Now, credit card delinquencies you see in this chart, this goes back to 1992. They're lower than they were during the GFC. All right, they peaked for all banks, emphasis all banks, they peaked at about 6.77% in 2009. Now, they got very low in 2022, and now they're rising. And guys, notice they're rising pretty fast right now. And as they're rising, the angle is steepening. The rate of change is increasing. And the last time that happened, 2007, 2008, right before things went vertical in 2009. So it's not yet at an alarming level. We're at 2.77%. We are just now, let's zoom in a little bit. For all banks' credit card delinquencies, we are just now breaking higher than where we were in 2020 before the pandemic. All right. So, but keep in mind, the balances are much bigger. Now we've got $1 trillion in debt, and the interest rate is much higher. So these delinquencies are going to increase at an ever faster pace because the interest is piling up faster and people are still putting life on the credit card. All right. So number is going to rise. Now, this is all commercial banks, though. Let's look at small banks. Now, this is a problem. This is the delinquency rate on credit cards for all banks, not among the 100 largest. So eliminate the GSIBs, even eliminate the regionals. Just take America's little banks. Look at what the credit card default rate is for America's little banks now. And guys, this chart is scary. This one worries me because look, here's the GFC. The credit card default rate for small banks in the United States was only 5.6% at its peak in the GFC. Now, small banks, there was a lot of consolidation in banking after the GFC, so a lot of small banks went away, and small bank credit cards became kind of like the dark alley of the debt market. If you can't get a credit card anywhere, you go to a small bank where you're going to pay a really high fee because you're a risky debt, you're a risky borrower, and only the small banks will lend to you. So this is your subprime credit card borrower. This is the riskiest corner of the credit card market. Look what these rates are doing, guys. Already back above pre-pandemic levels. We peaked in 2020 at 7.17%. It's already at 7.5%. It's actually at an all-time high. Credit card defaults at small banks are very, very high right now, 7.5%. Now, America's small banks are already struggling with losses from U.S. Treasuries, from the rise in interest rates. Remember, when interest rates go up, bond values go down. That's what failed Silicon Valley Bank, was losses from U.S. Treasuries. America's small banks are still struggling with that. America's small banks are still struggling with commercial real estate. Most of the commercial real estate debt is on America's small banks' balance sheets. And now America's small banks are struggling with delinquencies on credit cards at 7.5%. If 7.5% of people are not paying their credit cards, they're losing money on credit cards, right? That means 7 out of 100 people aren't paying. It doesn't matter how high the interest rates are. You're losing money now. So America's small banks are in trouble. Watch out for that next month when bank earnings start up again, because this wasn't such a big problem in the prior quarter. It's going to be now.
Well, these people aren't at a zero balance. You assume they're at some larger balance, 10, 15, 20 grand, when they said, you know what,
Yeah, they're just walking away. Did I lose your feed there, Mish? You went quiet for a second.
No, I'm still here.
Oh,
Yeah, they're going away. Hey, markets are closed if you want to run back through markets.
Yep, I got a few more of these I want to get through, and then we'll run through markets. We're gonna wrap up here soon. Now, look, guys, because of the rise in credit card delinquencies, because of the rise in the demand for debt, and because of the ever shrinking supply of money, banks are strapped for cash. And so a lot of people are being rejected. Check this one out, just a few days old. Applying for credit, be prepared to be rejected. A new survey found that the rejection rate for credit applicants increased to 21.8% in June, which is the highest it's been in 5 years. And look at some of these numbers. The rejection rate for auto loans increased to 14.2%. That was only 9% in February. It also impacted a wide swath of sectors, with rejection rates increasing for credit cards, 21.5%. Credit card limit increases, 30.7%. Remember when I said the bank would cut you off? It's coming, guys. They're already doing it to people. Mortgage rejections are up to 13.2%. Mortgage refinance applications rejected at 20.8%. Banks are tightening their lending standards. If you think you're just going to keep borrowing to maintain that 2019 standard of living, guys, the banks see what you're doing, and they're starting to say, Again, the availability of debt, it's drying up. This is a liquidity crisis in every corner of the economy is brewing. And even the banks are doing it. The banks are getting in on the big borrowing. The banks are buying money from each other. Banks load up on $1.2 trillion in risky hot deposits. Brokered deposits rose 86% from a year earlier, and regulators are growing concerned. A brokered deposit is when a bank says to another bank, hey, can I buy some of the money that your customers locked up in CDs? Right? Say, okay, my customers at my bank put their money in a CD. I don't have to pay them back the money for 2 years. And they locked up that money at just 2% interest. Well, I could take that money and I could broker a deal to sell those deposits to this bank that's struggling. All right, guys, I'll give you this money, but you're going to pay me 5.5%. And that's a really good deal for the bank that's making that loan. That's a terrible deal for the bank that's desperate for cash. And banks are doing this a lot now. Look at how quickly this is rising right now. This chart is going vertical. Over $1.2 trillion of brokered deposits right now. The banks are buying money from each other. They're outbidding each other for deposits. If you're one of the lucky few banks that has spare deposits, you can sell them to your struggling neighbors for a pretty handsome fee. This is liquidity drying up in the banking system. They're getting desperate. Oh, and also we've got withdrawals from 401ks. What happens when somebody sells money, sells assets in their 401k? What is lurking in 401ks? A lot of bonds, aren't they? And 401k hardship withdrawals are on the rise. That means people are selling their retirement plans. Why? Probably to get out of debt or to maintain their standard of living because they can't afford it anymore. Well, when you withdraw early from your 401k, what are you doing? You're selling stocks and you're selling bonds. You're making the liquidity problems worse. Every corner of the economy, liquidity is disappearing fast. The demand for money is up. The supply for money is down. And let's not forget CMBS delinquencies, commercial real estate, guys, America's worthless office towers, and the $1.5 trillion of office debt that matures in the next 2 years. They need to refinance that money, refinance that debt, or default on it. And if they default on it, the supply of money shrinks. If they refinance it, they suck liquidity out of the bond market. Either way, money gets more scarce. Every corner of the economy, this is happening, guys, everywhere. There's no exception to this. And I just want to add one thing. As this deflationary nightmare on the horizon lurks, should you feel so inclined this weekend, guys, I spent a good couple of hours yesterday reading this, and there is a link in the description below. This is a free book written by a guy named David Rogers Webb. I'd never heard of him before this book. It's called The Great Taking. And I haven't had a chance to fact check everything in this book, but he's a very well-read, very well-researched guy. You can tell by what he's saying. A lot of what he did say in the book, I know ahead of time from my own research. So Most of what he said, I already know to be true in this book, and there's a few things I want to go verify. But wow, shout out to my dad who recommended this, and my dad heard about this on Mario Ineco's channel, Mineco64. Guys, this deflationary bust was set in motion years ago, and they have planned for it. And I've had a lot of people ask me, what happens to my stocks if Robinhood goes bankrupt? What happens if the company that I have my 401k with goes bankrupt? What happens to my pension if my company goes bankrupt? Read The Great Taking. There's a link down in the description. It's a free book. It's available in PDF format or HTML format. Read this one, guys. I've already sent an email to this author. I'm going to try to get him to come on the channel and talk to us about this. Wow. Just wow.
Well, in the end, you don't hold it, you don't own it, is what it kind of comes down to.
I'm going to give you a little hint because I took a lot of notes when I was reading this book. I could not put this down when I started reading this yesterday. I was dumbfounded by it. What you own is not a stock. Say you have a TD Ameritrade account and you went and you bought NVIDIA stock. Why? Because you ignored Jack and you just went and bought NVIDIA because AI, bro, AI. You didn't buy NVIDIA stock. You don't own NVIDIA stock. What you bought was a security entitlement. And this is a legal term because that NVIDIA stock, you don't own the paper share certificate. That NVIDIA stock is in a pool. It's in a pool of shares. And those shares are owned by the CCP, the central clearing provider. And what you own is a claim on a fraction of the stock that is in that pool. There is no share somewhere on a shelf with your name on it that says this one belongs to Melonhead. He bought it. Nope. What there is a line item, a line of text that says Melonhead owns 0.0000000% of this pool of assets. You are entitled to a portion of the securities held in that pool. And the problem is the law has been written that says the important creditors get paid back first in the event of a default. And if there's anything left over, maybe you'll get some as long as your lawyers are better than the next guys. How good is your lawyer? I hope he's pretty good. Not better than JP Morgan's. That's for sure. Security entitlement. Look that up. That's scary. This book, wow. David Rogers Webb, incredible work out there. Please come on the channel and talk to us about this. All right, guys, the markets are closed. We got the S&P closed at 4450, down 55 points on the day, or 1.22% lower. The Dow closed down 288, or 0.83% lower on the day. Bad day for the Dow, and the NASDAQ closed down 217 points, or 1.56% lower. And real quick, I just want to say one thing. Let's see what happened at the end of the day to NVIDIA stock. What did NVIDIA do? Down $16, 3.7%, currently trading after hours at $438. Wow, that thing was trading at $515 after hours after earnings. Huh. And I was told, don't listen to Twitter randos. That's interesting. Look at the 1-month chart. Look at what NVIDIA stock has done since that blowout earnings report on August 23rd. Just going to throw that one out there. Maybe more to come on that one in the future. Maybe not. All right, guys, we have been going a long time. Listen, oh my God, I'm so deep. What happened? My iPad froze up.
You've got
I didn't.
You got several.
I didn't. I didn't realize all these guys were in here. Thanks for the education, fellas, says Captain Keebs. Oh, let's bring Mish back. Sorry, Mish. I didn't mean to drop you there. Captain Keebs says, thanks for the education, fellas. You are so welcome, Captain Keebs. Guys, I hope you're learning something from this channel. I love doing this. I love to hear from you guys when you hear, I take confusing things and that I put them in terms that everyday people can understand. Guys, this stuff is not that hard, all right? There's some very basic concepts and relationships that once you get them down, it doesn't require college degree even. It doesn't require high school level math, middle school level math, really. All right. What happens is the financial industry uses a lot of terms and a lot of language that most people are afraid to look dumb. Oh, they're using some term I don't know, so I'm just not going to challenge what I just heard because I don't want to lose the power in the conversation. Don't let that BS intimidate you from this stuff. All right. Because the people in the finance industry, spend some time talking to them. They are not smarter than you. Trust me. Trust me. I have met some really stupid a-holes that work in this industry. Trust me, guys. You know what they're really good at? Sales. They're salesmen. Most of the people in the finance industry, their job is to convince you to part with your money to buy whatever they're selling. All right? They are not smarter than you. Don't think that for a second. They get off on convincing you that they're smarter than you. They're definitely not. Thank you, Captain Keeves. I appreciate the kind words and the support of the channel, sir. And thank you, East Pro. RE Paper Silver, it's falling fast. Elaborate, please. All right, let me just say, guys, and read The Great Taking, East Pro. Read The Great Taking, because paper claims, I'm going to expand on your logic here, not just silver. What's happening with silver is happening with stocks. It's happening with bonds. It's even happening with real estate debt. All right, paper claims. Most of what you think you own is a paper claim to somebody else's asset, and the whole system has been set up so that if there is not enough money to pay for all the paper claims, the banks get it and you don't. And that's why I have never been a bigger fan of the shiny. All right, you hold it, you own it. All right, do not settle for paper claims. As far as what's going on specifically in the silver market, guys, the same bar of silver has been bought and sold 100 times, 1,000 times. Nobody really knows. It's been done by the same they that has done it with the stocks, that's working at the Fed. So ultimately, it's just another mechanism for siphoning wealth off of the masses and into their pockets. You know, and thank you very much, East Pro. I appreciate the super chat, sir. Watch those silver markets. The inventory's jumped up a little bit recently, but I don't buy it. Thanks again, East Pro. And thank you, Dan Hadeen says, way to go, Jack. Name the movie. Way to go, Jack. Is that Big Trouble in Little China? I don't know. My first name is so overused in Hollywood. I've met a few Jacks. You know, there's a few of us out there, but the name Jack is not nearly as common as Hollywood would have you think, because Jack is synonymous with average. You know, any Jack knows this. So Hollywood loves to take average people and put them in extraordinary circumstances, and so they use the name Jack to make the protagonist more relatable to everyday people. I don't know why they do it so much, but wow, it's hard to name that movie. Way to go, Jack. I'm going to say Jack Burton from Big Trouble in Little China. I don't know. But thank you very much, Dan Hadeen. Appreciate super chat, brother. And thank you, Steve Woitis. Says 401k withdrawals on the rise. Who's buying stocks and keeping these markets up? Magnetar Capital is keeping this market up. That's my take. What I looked at and what I found with the flow of money from Magnetar to CoreWeave to NVIDIA, I'm willing to bet that is happening at some level, maybe not to that grotesque extent by such sleazy players, but I'm willing to bet something like that is happening in each of the Magnificent Seven involving some hedge fund or some asset manager. I think they realize they can keep this flywheel spinning a little bit longer by pumping a few key stocks, convincing retail traders to FOMO in and use them as exit liquidity. It's a pump and dump. I'll be honest with you. AI technology is awesome. AI tech could be massively deflationary. It could be a big productivity enhancement tool. AI mania in the stock market is a pump and dump. Mark my words. Thank you very much, Steve Woitis. Appreciate that, stir, in the super chat. And whoa, Ewok jerky. Enough for Taco Bell. Fun fact about Taco Bell.
Not a family of four anymore.
Not a family of four can't eat a Taco Bell anymore?
I saw someone last night, the family of four, $54.
Wow. For taco smell, huh? $54. You know, fun fact, Taco Bell is how I knew my first daughter was coming. My wife and I, we were driving down the Garden State Parkway. We stopped for gas. She was following me. We both had our cars. This was right after our wedding. Just made it, says the Catholics. Just after the wedding. And, you know, we're filling up the tanks. I rolled down the window and went to talk to my wife. And she says, I want Taco Bell. And I looked at her and I said, you're pregnant. And she says, what? And I said, we dated for 3.5 years before we got engaged. And we were engaged for about 9 months afterwards. So we were together for quite a while before we got married. I said, all the time I've known you, you never once told me you want Taco Bell. You're pregnant. It's like, I'm going to go get you tacos. You go right to the pharmacy, get a pregnancy test. Sure enough, our oldest daughter was on the way. you're still cool with the Catholics if you don't find out about it until after the wedding, right? Right? Catholics, can I get a thumbs up? Legit? No? Anyway, just made it. It didn't really happen if you didn't know about it until afterwards. So, yeah, that was my Taco Bell story. That's how I knew my oldest daughter was coming. Thank you, Ewok Jerky, for nearly enough for a family of 4 to eat at Taco Bell. I appreciate that, the super chat and your generosity, sir. And Caleb from Canada is saying, your go-to cold wallet for privacy and security. Caleb, listen, I'm struggling with that one right now, my go-to wallet. All right, so I'm going to defer to my buddy Patrick over at SatPulse for this one. All right, I'm going to recommend you go to him with that question because my go-to wallet used to be the Ledger Nano X. All right, emphasis used to be, because when Ledger created that option for storing your private keys with them, what they basically did was they devalued the security of that product. They created a backdoor. Now, they gave you the option to opt out, but just the fact that exists creates a backdoor into that. So you may have noticed my videos no longer include the affiliate link to the Ledger Nano X because of that, because I can no longer recommend that wallet. And everything I recommended, there is no perfect solution for a crypto wallet. Nothing is flawless. There's some that are better than others, but I still have not found another one to recommend. I still use my Ledger Nano X. It's still out there, but I'm looking for a replacement, and it's just the demands on my time. I haven't found one to replace it with yet. So, Caleb, I'm sorry, I don't have one to recommend, but I can tell you I trust my buddy Patrick's judgment. Divvy Daddy, a.k.a. Patrick Hakeem, over at SatPulse channel. He's on Twitter also. He's a sharp guy, and he knows his crypto. So I'm going to defer to his sound judgment on that one. I'm going to recommend, tell him nobody sent you. Say, hey, Jack, and nobody special said I should ask you. He's got a couple of ones that he recommends. Just understand nothing is perfect, all right? There is no perfect security. There's a way around or a vulnerability to just about anything. So just be careful, be smart with your private keys, and protect them from your own lapses in judgment. Also, you can lose your private keys. You could lose your wallet. Make sure you have a way for yourself to recover it too. But there is no perfect answer in this one. Unfortunately, everything has some drawbacks. There's no perfect solution. All right, guys, we have been going for way too long. Hour and 17 today. We're going to call it there. Mish, you got anything you want to add, brother, before we wrap this one up?
Stay safe.
All right, everybody, stay safe. Happy Lehman Brothers anniversary. And guys, seriously, if you want some light reading for the weekend, check out The Great Taking. You can read it in one sitting. It's about 130 pages, and it's in the middle of it gets a little bit hard. There's a lot of acronyms and things. And, I took a lot of notes, and I was referring to my notes as I was reading back and forth. So it does get tough in the middle. It's got a great beginning, and it's got a great ending. It's a little hard to get through in the middle, but I highly recommend The Great Taking. Wow. Just wow. What they, with a capital T, have done. Good read. Highly recommend, by David Rogers Webb. Link down in the description. All right, guys, I want you to have an awesome weekend. Remember, I always say hard times are coming, but they're not here yet. So enjoy this weekend. Spend some time with your family. Get some stuff done. And thank you, everybody, for your generosity, for your super chats. Thank you to my Patreon supporters for everything you guys do. I will see you guys in 2 weeks in Vegas at the Silver Symposium. Hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.